Something extraordinary is happening in the global silver market, and almost no one outside a small circle of traders is paying attention. For decades, one exchange has quietly decided the price of silver for the entire world. Not a mine, not a refinery, not even the physical metal itself. A paper contract, traded thousands of miles from where the real silver sits. But that arrangement is now beginning to break. Because in China, something has shifted. A signal buried in customs data, a pattern in bank vault withdrawals, a quiet change in how the East is choosing to hold its wealth. And if this trend continues, the mechanism that has controlled silver prices for generations may not survive the decade. By the end of this video, you will understand exactly what is unraveling, and why the professionals who see it first will be the ones positioned before it becomes headline news. Welcome back to Precious Metals Intelligence, a channel built for those who prefer to understand what is happening in the global economy before it becomes common knowledge, rather than after. If you are new here, this channel is intended for a specific kind of viewer: business professionals, long-term investors, and individuals who take the preservation of their capital seriously. We do not chase headlines, we examine structures, the quiet mechanisms beneath the surface of markets that, over time, determine who preserves wealth and who does not. Before continuing, I would genuinely like to know, where in the world are you watching this from today? Please share your city or country in the comments below. Over the years, this community has grown into a remarkably global one, and it is always worth pausing to appreciate just how far these conversations travel. To understand what is happening in the silver market today, one must first understand a simple but uncomfortable truth. For more than 50 years, the price of silver has not been set by the people who mine it, refine it, or use it. It has been set by traders who often never touch the metal at all. This is the story of Comex, the commodity exchange based in New York. It is the place where each day the world quietly agrees on what silver is worth. Miners in Mexico, refiners in Switzerland, jewelers in India, and factories in China all look to this single exchange for their price. Yet very few of them ever send or receive real silver through it. Here is why that matters. When someone buys a silver contract on Comex, they are not buying silver bars sitting in a vault. They are buying a promise, a paper agreement that says, at some future date, silver will be delivered. In theory, every contract could be exchanged for real metal. In practice, almost none of them are. Analysts who study the exchange have found something striking. For every ounce of physical silver actually sitting in Comex vaults, there are many, many ounces of paper contracts trading against it. Some estimates place this ratio at well over 100 paper claims for every real ounce available for delivery. This is not a conspiracy theory. It is simply how the exchange has operated for decades, and for most of that time, it worked without major incident. Why did it work? Because most traders never wanted the physical metal. They were speculating on price movement, hedging business risk, or managing portfolios. Very few had any actual use for a silver bar. As long as almost everyone kept playing the paper game, and almost no one asked for delivery at the same time, the system held together smoothly. This arrangement gave enormous power to a small number of large financial institutions. By controlling the flow of paper contracts, they could influence the price of silver without needing to hold much actual metal. When paper selling increased, the price fell, even if real-world demand for silver was rising. When paper buying increased, the price rose, even if physical supply was tight. The paper market, not the physical market, became the true price setter. For decades, the system faced little serious challenge. Physical demand for silver, while steady, rarely grew fast enough or urgently enough to strain the vaults. Industrial buyers took what they needed. Investors bought coins and bars in modest amounts. The gap between paper claims and real metal stayed wide, but it stayed manageable. But something is changing now, and it is changing in a place the old system was never built to handle: China. China's relationship with metals has always followed a distinct pattern. It does not simply consume what it needs and stop. It produces enormous quantities of raw materials and then imports even more, often building reserves far beyond immediate use. This has already happened with gold, copper, and rare earth elements. Analysts are now watching the same pattern begin to appear in silver. This shift matters because silver is not only a monetary metal like gold, it is also an industrial one. It is essential for solar panels, electric vehicles, and electronics, all of which China is producing and installing at massive scale. This means China's demand for silver is not driven by a single motive. It is driven by both investment thinking and industrial necessity at the same time. That combination has never fully tested the Comex paper system before. For the first time in decades, a major economic power has strong reasons to want physical silver, not paper promises. And if enough large buyers begin asking for real delivery instead of settling in cash or rolling their contracts forward, the foundation of the Comex pricing system begins to show its age. This is not a small technical detail buried in financial reports. It is potentially the beginning of a structural shift in how the world's silver is priced, who controls that price, and where real physical metal ultimately ends up. In the next part, this story will examine exactly how China's demand for silver has evolved, what the data shows about its imports and reserves, and why this shift did not happen overnight, but has been building quietly for years. A pattern rarely announces itself loudly. It builds quietly in customs records, shipping manifests, and bank vault reports, long before most people notice it at all. This is exactly how China's relationship with silver has evolved, and understanding this pattern requires looking back at how China has behaved with other critical resources first. Consider gold. For years, China has been both the world's largest producer of gold and, at the same time, its largest importer. This sounds contradictory at first. Why would the top producer of something also need to import more of it than anyone else? The answer lies in intention. China is not simply meeting current demand. It is building a reserve for the future, one large enough to matter on a national and even geopolitical scale. The same pattern has appeared with copper, with rare earth elements, and with several other industrial metals. China produces at massive scale, then imports even more, often quietly, often without fanfare. Analysts who track this behavior describe it as long-term positioning, not short-term consumption. China's leadership has repeatedly stated that it thinks in terms of decades, not quarters. Western economies, by contrast, often plan around election cycles or annual earnings reports. This difference in time horizon matters enormously when trying to understand why China accumulates resources the way it does. Now, this same behavior is beginning to show up in the silver market, and the reasons are more layered than with gold alone. Silver holds a unique position among metals. It is precious, like gold, valued by investors and central banks as a store of wealth. But it is also deeply industrial, used in ways gold never has been. Solar panels require silver in their electrical conducting layers. Electric vehicles use it in wiring and battery systems. Advanced electronics, medical devices, and even water purification systems depend on it. No other metal serves both a monetary role and such a critical industrial role at the same time. China happens to be the world's largest producer of solar panels and one of the largest producers of electric vehicles. This means the country's demand for silver is not a single force. It is two forces moving in the same direction at once. Industrial factories need silver to keep production lines running. At the same time, investors and financial institutions within China are showing renewed interest in silver as a store of value, much the way they have with gold. Trade data over recent years has begun to reflect this. Import volumes into China have shown a clear upward trend, and refiners have reported unusually strong demand for physical bars and industrial-grade silver alike. Bank vaults in major Chinese financial centers have also seen rising inflows, a detail that rarely makes international headlines, but is closely watched by those who study physical metal markets professionally. What makes this development significant is not simply that demand is rising. Demand for silver has fluctuated many times before without shaking global markets. What makes this moment different is scale, combined with intention. When a nation the size of China begins treating a metal the way it has already treated gold, the effect on global supply becomes difficult to ignore. There's also a quieter, more strategic dimension to this story. China has spent recent years building its own financial infrastructure for metals trading, separate from Western exchanges. Markets in Shanghai and Hong Kong have expanded their role in pricing and storing physical metal. This effort mirrors what China has already done with gold, where it has worked to establish pricing mechanisms that are not solely dependent on Western exchanges like Comex or the London markets. If this same infrastructure extends fully to silver, the implications become significant. A country with enormous industrial demand, growing investment appetite, and its own developing exchange system would no longer need to rely on prices set thousands of miles away by traders who may never touch a single ounce of real metal. This is the foundation of the shift now underway. It did not happen suddenly, and it has not been driven by a single announcement or event. It has built steadily, year by year, through trade flows, industrial expansion, and a long-term mindset that values physical control over paper promises. In the next part, this story will examine the growing pressure this shift is placing on Western vaults and exchanges, and what happens when physical demand begins to outpace the supply of real, deliverable silver. Every system built on promises eventually faces a moment of testing. For the Comex silver market, that moment is beginning to arrive, not through a dramatic collapse, but through a slow and steady tightening that is becoming harder to explain away. For most of its history, the paper silver market functioned smoothly because very few people ever asked for the real thing. Traders bought and sold contracts, prices moved up and down, and almost no one walked up to the vault and said, "I would like my silver now." This is what allowed the system to support far more paper claims than actual metal in storage. As long as demand for delivery stayed low, the gap between promises and physical supply simply did not matter to most participants. That quiet arrangement is now under visible strain. Reports from within the exchange have shown a noticeable rise in the number of contracts being taken to physical delivery rather than rolled forward or settled in cash. This may sound like a small technical shift, but for those who study these markets closely, it is a meaningful signal. It suggests that a growing number of buyers no longer want a paper promise. They want the metal itself moved into their own possession. At the same time, registered inventories, the silver actually available for delivery, have shown signs of decline in certain periods, even as total paper contracts outstanding remain enormous. When the amount of silver sitting in vaults shrinks, while the number of paper claims against that silver stays high or even grows, the ratio between promises and physical metal becomes increasingly stretched. Analysts sometimes describe this as a coiled spring. The pressure does not disappear. It simply builds quietly until something forces a release. One of the clearest signs of this pressure shows up in something called the premium, the difference between the price of a physical silver coin or bar and the official paper price quoted on the exchange. In a healthy, balanced market, this premium stays small and stable. But during periods of real physical stress, premiums have widened noticeably. Buyers have been willing to pay significantly more than the paper price just to secure actual metal in hand. This tells a simple story. Somewhere in the system, real silver is becoming harder to find at the price the exchange claims it is worth. This is not the first time the silver market has faced pressure of this kind. In past decades, there have been moments when physical demand surged and delivery requests spiked, only for the pressure to ease as new supply entered the market, or as large institutions stepped in to calm conditions. Each time the system bent, but it did not break. What makes the current moment different is the combination of forces arriving at the same time. Industrial demand for silver, driven by solar panel production and electric vehicle manufacturing, continues to grow steadily and shows no sign of slowing. At the same time, investment demand is rising, particularly from buyers in Asia, who increasingly view silver the way they have long viewed gold, as a store of value worth holding physically rather than on paper. In earlier decades, these two forces rarely peaked together. Today, they appear to be converging. There is also a structural factor that did not exist in earlier squeezes. Alternative pricing and storage systems, particularly those developing in Shanghai and Hong Kong, now offer large buyers a genuine option outside the Western paper system. In the past, if someone wanted to buy or sell significant quantities of silver, Comex and London were essentially the only serious venues available. That is no longer entirely true. This gives major buyers a choice they did not have before, and choice changes behavior. A buyer with an alternative is far more willing to demand delivery, or simply walk away from the paper market altogether, rather than accept a price they consider disconnected from physical reality. None of this guarantees an immediate or dramatic outcome. Markets under strain can remain strained for a long time before anything visibly changes, but the signals are no longer subtle to those watching closely. Rising delivery demands, shrinking registered inventories, widening premiums, and the emergence of real alternatives all point in the same direction. The paper system that has quietly set silver's price for decades is facing pressure it was never truly designed to withstand. In the next part, this story will examine what may happen if that pressure continues to build, and what a genuine break between paper price and physical reality could mean for markets, industries, and everyday holders of silver around the world. Every strained system eventually reaches a fork in the road. It either finds a way to release pressure gradually, or it breaks suddenly, forcing a violent correction that catches most participants unprepared. For the Comex silver market, both paths remain possible, and understanding each one matters for anyone trying to make sense of where this story leads. The first path is the gradual one. In this scenario, the exchange and its major participants slowly adjust to rising physical demand. Premiums stay elevated but do not spiral out of control. Delivery requests continue increasing, but large institutions manage the flow carefully, perhaps by sourcing additional metal from secondary markets, encouraging new mine production, or quietly settling more contracts in cash rather than physical silver. Prices rise over time, reflecting real scarcity, but the system itself remains intact. This is the outcome regulators and major banks would clearly prefer. It allows adjustment without panic. The second path is far more disruptive. In this scenario, physical demand accelerates faster than the system can absorb. A large buyer, or a group of buyers, requests delivery at a scale the exchange struggles to meet. When that happens, the illusion that paper contracts are fully interchangeable with real silver becomes impossible to maintain. If the exchange cannot deliver, it may be forced to settle contracts in cash instead at whatever price it chooses, effectively breaking the promise the paper contract was built on. This is sometimes referred to as a default, though it rarely gets described that plainly at the time. When something like this occurs, the trust underlying the entire paper pricing system can weaken quickly, and price discovery may shift almost overnight toward wherever real physical metal can still be bought. This is where Shanghai and Hong Kong enter the story again, and their role becomes especially important in this scenario. If Western paper markets falter or lose credibility, buyers and sellers need somewhere else to determine a fair price. Exchanges in China have spent years quietly building the infrastructure to serve exactly this purpose, offering physically backed trading and settlement outside the traditional Western system. Should a real crisis of confidence emerge in Comex pricing, these alternative markets would be positioned to absorb a significant share of global price-setting activity, not by accident, but because they were deliberately built with this possibility in mind. The consequences of such a shift would not stay contained to silver alone. Silver and gold have long moved in relation to one another, and a breakdown in silver's paper pricing system would likely raise serious questions about gold's paper markets as well, given that they operate on remarkably similar principles. Investors and institutions who have grown comfortable trusting paper claims across many asset classes might begin reconsidering that trust more broadly, a shift with implications reaching well beyond precious metals into currencies and broader commodity markets. For industrial buyers, the impact would be immediate and practical. Solar panel manufacturers, electronics producers, and automakers all depend on predictable silver supply at reasonably stable prices. A sudden disconnect between paper and physical pricing would force these companies to secure metal through direct physical contracts rather than relying on exchange pricing, likely at higher and less predictable cost. For investors and everyday holders of silver, the implications cut differently. Those holding physical silver directly rather than paper claims, such as certain funds or unallocated accounts, would find themselves holding an asset whose true value the old pricing system had been suppressing for years. Those holding only paper exposure, on the other hand, might discover that their holdings do not behave the way they expected precisely when it matters most. Nothing about this outcome is guaranteed, and timing remains impossible to predict with precision. But the direction of pressure is becoming increasingly clear to those willing to look closely at the data. In the final part of this story, attention turns to what this shift means practically and how thoughtful, long-term minded individuals might consider positioning themselves as this structural change continues to unfold.